So I want to say this example as well because I don't think a lot of people are aware of it. So if you take, for example, the Public Debt Management Act, which was another law that we passed in 2024, this law poses restrictions on the ability for the government to freely give treasury guarantees to SOEs, right? So, I mean, not only SOEs, but in general, the ability to give treasury guarantees. A treasury guarantee or a sovereign guarantee is like, it's almost like a letter that is given when, okay, let's take, for example, the CEB, and they want to get a loan from like an external bank, let's say, like an investment bank abroad or something like that, and they say, okay, we want to get this loan, and then the treasury would give a letter saying, if the CEB doesn't repay this loan, we will give the money instead. So it's almost like a letter of support saying that we will cover this. So now with the Public Debt Management Act, the treasury can't even just give it freely. You know, in fact, the law actually says that, you know, a guarantee will only be granted to entities that are not considered to be in financial distress. And how they determine this financial distress is that the Public Debt Management Office, which is something that was very recently established just last year, they will conduct a credit risk assessment. So of the entity. So if they take the CEB, they'll make the CEB undergo a credit risk assessment, and based on what this assessment says, they will price a credit risk, and they will charge a guarantee fee to reflect the risk that is borne by the government in giving the treasury guarantee. So actually, very recently there was a news report that came out that the CEB's request for just a $50 million loan from the Asian Infrastructure Investment Bank, that if it were backed by a government guarantee or treasury guarantee, that they would have to pay a 4.8% premium that is on top of the interest to the treasury to get that guarantee.
That's quite a lot.
Exactly. So it's very expensive.